You're listening to The Money Hour with your host, Tina Mitchell, on Alternative Talk, AM 1150. Now, back to the show with local mortgage and finance expert, Tina Mitchell.
Welcome back to The Money Hour with your host and mortgage expert, Tina Mitchell, right here on 1150 AM KKNW, the Saturday, March 11th show. I'm committed to providing you knowledge needed to be successful in every area regarding your finances. Knowledge is power, and that's what you'll receive from listening to the show today. If you're hearing my show at a different time or day, you are listening to a rebroadcast, but you can call the show at 1-855-400-1150 or online at themoneyhour.com to ask any questions to my guests that I have in studio today. Right now, I'm going to have a conversation with Tony Sablan with Ultimate Wealth Strategies, New York Life, Market Strategies, and Volatility in the Market. Tony, thank you so much for coming back in studio.
Yeah, thanks for having me, Tina.
And a little bit about Tony. Tony Sablan is an advisor with New York Life. He is also the founder of Ultimate Wealth Strategies based in Bellevue, Washington, focusing on life insurance, investment, retirement, estate planning for you, your family, or small business to identify your life goals and motivations. He has a vast team of specialists that will help you meet your goals. Not only does he enjoy helping people with their financial goals and dreams, he is also passionate about the community through his involvement with a variety of nonprofits. And something that's unique about Tony is that he is a mixed martial arts coach at AMC Pancration in Kirkland, Washington, training alongside current UFC champions, one FC champion, and other world-class fighters. So, Tony, it's not only do you help people with their finances and putting a good financing plan, but you can actually help them in self-defense.
Yes, we can.
Yeah, that's awesome. Our topic today, I think, is a great one, market strategies and volatility. And it's a really interesting topic, and I'm sure a lot of my listeners are asking, when is the right time to invest?
Well, many of Wall Street's economists and market strategists make a good living trying to answer this question, often guessing where the market is headed. Sometimes they're right and sometimes they're wrong. But one thing's for sure, market diagnosis is a lot easier and clearer than market prognosis. And as Warren Buffett once said, in the business world, the rearview mirror is always clearer than the windshield. So to avoid overreaction and let our emotions dictate our financial future, it is important to keep a long-term perspective and stop trying to guess where the market is going. Mm-hmm. Have a plan before you get into the market.
So, Tony, I know you talk a lot about emotions, and anything's emotional when we're talking about our finances and we're talking about the future for our family and our lives. So would you elaborate on how emotions can affect the way that you invest?
Well, our emotions are difficult to keep in check, however, especially when our money is at stake. So investors experience an emotional roller coaster of some sorts as their investments endures the highs and lows of the markets. And generally that's, begins with optimism, excitement, thrill, euphoria, which is what we're experiencing right now with the market. Mm-hmm. And, that is also the point of maximum financial risk, because at the other end of that is anxiety, denial, fear, desperation, panic, and despondency, at which that is the point of maximum financial opportunity. And once you take advantage of that financial opportunity, then we get out of depression, there's hope, mm-hmm. there's relief, and then we're back to optimism again.
Yeah.
So with that in mind, a successful investing strategy is having a long-term plan and perspective as well.
And I'd imagine, too, when you're talking about all those different emotions, you want to catch it at fear and do something instead of procrastinating and getting it to where it gets to a whole higher level. So, Tony, how would you advise someone to be able to take the emotions out of it and in that decision-making process when they're actually investing?
So being disciplined is very important, and not letting your emotion make the investment choices for you. Mm-hmm. And to illustrate the reality of a long-term disciplined investment approach, $1 invested 85 years ago would be worth roughly about $26,400 investing in small stock or mm-hmm. small cap stocks. And in large cap stocks, that's about $5,300 according to the iButson chart, which you can find online.
Okay.
And so really it's about being disciplined and having a plan and taking the emotion out of your investment choices.
Makes total sense. So a lot of my listeners may, or most likely may not, be able to time the market performance-wise. And, how does timing versus having a disciplined approach affect one's portfolio?
So a key characteristic that distinguishes a professional investment manager from the average investor is that, like I mentioned before, discipline is part of their investment strategy. Individual investors often let emotion or short-term market events drive their investment behavior. So think about the Trump effect. People were worried about what would happen if Trump took office, but the opposite happened.
Exactly.
And the market shot up. So fear and greed are often powerful motivators to do exactly the wrong thing at the wrong time. And according to a recent study conducted towards the end of last year, over a 20-year period, the average investor achieved less than half of the annual returns versus professional investors. And, that's 5.5% over the same period that the S&P 500 did returned 13.69%. So, and, past performance does not guarantee future results.
Exactly. It was interesting after the elections because I always show the bond market and helping to educate clients on interest rates and what interest rates have done, since we can't predict what they're going to do in the future. But right after the election, the bond market just tanked. And I always tell my clients, if you watch the stock market, normally the bond market's going to work opposite of it. So yeah, you just don't know because you would have thought it would have been the opposite. So given we're an all-time high, historically, how has the market performed, Tony?
So historically, the stock market has been up more than down. And after a lengthy bull market, some people tend to lose sight that their investments might actually generate negative returns. And this exemplifies the importance of maintaining realistic expectations about your investments, especially if returns move closer to their historical averages. And given that we don't know where the market will be 2 years from now, should you be prepared to stay invested? The market has been up 12% or more, about 50% of the time since 1926, and it has had positive returns 73% of the time, but it's also been negative roughly 27% of the time. So the market can help provide the growth engine investors need to provide future income and combat inflation, but since no investment is without risk, you need to be prepared to endure market fluctuations and slumps and understand that there are reasons for them. And historically, once the reasons are addressed, the market bounces back. And that's why it's important for investors to keep a long-term perspective.
Just like purchasing a house, you lose money in real estate when you're forced to sell in a bad market, or you get scared in a bad market. You've got to hold and get through those times and take that emotion out of it. A little bit different when you're talking about your money than you are your home, but same philosophy. So what are some basic of investing to begin in the design process, Tony?
So the basic tenets of a successful investing strategy are asset allocation, diversification, rebalancing, working with a financial professional, and diversifying your investments in the different types of investment vehicles available to you.
So let's talk about asset allocation.
So asset allocation is essentially building a diversified portfolio that combines the other major asset classes, and that's equities, which is stocks, fixed income, which is bonds, and cash equivalents, which is cash.
Okay.
All asset classes do not perform alike, and one asset class may fall, the other may rise, and that's what helps keep your portfolio at a really steady upward trend rather than going through the ups and downs if you're heavily invested in one asset class.
So what about rebalancing?
So rebalancing is essentially taking the winners and investing in the losers from the previous year. Because if there's what we call a Kellen chart that shows the historical performance year over year over the last 10 years of the different asset classes, and you'll find that winners in 1 year aren't necessarily the winners the next year. So it would make sense to sell high and buy low, which is essentially what you're doing with rebalancing. Okay, and really important diversification. Diversification. You hear that a lot, but I think what a lot of people don't forget is not only would you diversify your mutual fund holdings, but you'd want to diversify the different investment vehicles that you have access to you. And that could be in stocks, bonds, cash, real estate, life insurance, annuities. They all perform differently in different market classes. So it makes sense. Like if you wanted a bulletproof financial plan, then it would make sense
to be diversified in all of those.
In all of those, and not just your individual portfolio.
Exactly. You definitely don't want to have everything in one asset class, and ideally you've diversified in all of them. So why is it important, Tony, to work with a financial professional?
Well, according to
I know why it's important. Tell my listeners.
According to a recent article by U.S. News, a big part of it is crisis management. So transitioning the management of your portfolio from a spouse or an heir, having a financial advisor makes that seamless and easy. A second reason is, someone else to crunch the numbers. You probably want to focus on something else in retirement rather than opening up your retirement and then watching Bloomberg each day.
Sure.
You'd rather be golfing, working on a new hobby, starting a new business. But just having someone else to crunch the numbers frees you up for the more important things in your life. The third reason is guarding against cognitive declines. So, even if you are a wealth building expert, you may not be able to properly manage your portfolio one day in the future. So you could experience cognitive or physical declines or other health problems that would render you unable to properly manage your money. Fourth is just having a second opinion on your spending plan. What we find for retirees, if all your money's invested in one basket, then you're naturally going to either increase your lifestyle or decrease your lifestyle, depending on what the market does. But designing a financial plan that takes into account market declines or market upswings, and just having you maintain your current lifestyle is, would be a prudent investment strategy. Having someone with a second opinion.
Tony, what are some investment vehicles people should consider when planning for retirement?
So as I mentioned earlier, there's stocks, bonds, mutual funds, fixed and variable annuities, life insurance, real estate. And by having a diverse set of investment vehicles, it puts you in a better position to withstand the market's ups and downs.
So just a minute left here. Just I'd like to leave my listeners, Tony, with a lasting thought from you.
Yeah, I'm gonna say it again. Make sure you are diversified with the different investment vehicles available to you, and give me a call.
Tony, thank you so much for coming back in studio. I really appreciate it.
Thank you, Tina.
Coming up next on the Money Hour, fired up and ready to sue? You might want to think again. In studio, I have Vincent Humphrey with Humphrey and Associates right here on 1150 AM KKNW after this short break.